Welcome, everybody, to Secret Sauce, the show where we hear real-time insights from commercial real estate industry leaders. I'm Karly Iacono. Today, I am happy to be joined by Eddie Rivera, the partner at Sax LLP. Welcome to the show, Eddie. How are you today?
Doing well, Karly. Thank you for having me.
So glad you could join us. Really happy to have you. So today we're going to cover a few different topics. We're going to start with an overview of the latest updates on opportunity zones, and then dive into some federal and state tax tips, advice, or food for thought for our listeners. But before we get through all of this great and very important content, Eddie, why don't you take a minute and just tell us about Sax and your role there?
Karly, thank you. I appreciate you having me on here. So Sax is a top 100 CPA firm based out of Parsippany, New Jersey. We have offices in New York City and Princeton, in addition to the Parsippany office. I'm a tax partner at the firm, and I'm focused in the real estate group, where I provide tax advisory services, business planning services, and other general business advice to real estate clients, as well as construction clients and private equity firms.
The perfect background for today's episode. Really, thank you. Thank you for that overview. And I think we should jump in. I want to start with, and I really think of today's episode in two parts because they are a bit different, but I want to start with opportunity zones. So this, to me, was a program that just had amazing attention when it rolled out. Gosh, what was it? 5 years ago? Has it been 10 years? I'm not sure. You'll let me know.
About 5 years.
5 years. Okay. But where are we today with opportunity zones? And maybe we should even start a little more basic. What is an opportunity zone and how do they work?
Yeah, so it's a great question. I think a lot of people hear there's a lot of information in the media about opportunity zones. Basically, as part of the Tax Cuts and Jobs Act in 2017, the Opportunity Zone program was created, and an opportunity zone is basically a census tract area in any given geography. Back in 2017, all the states, as part of the federal tax law, all the states were required to designate various census tracts in their state as opportunity zones. And what that did was it created a neighborhood in that census tract that could be developed where federal benefits where it was eligible for federal benefits, excuse me. So basically, an opportunity zone, what the opportunity zone law says is any individual or organization that has a capital gain from the sale of, for example, stock, publicly traded stock, you can take that gain and you can roll it into an investment in an opportunity zone. At this point, 5 years on, I've seen investments in everything from apartment buildings to industrial warehouses to car washes. Early on it was a little slow, but now you're really starting to see some of this activity ramp up. The main benefit aside from deferring the gain, once you defer the gain that you recognize, if you hold an investment in an opportunity zone for 10 years and sell that investment, the investment will be tax-free. Certainly for federal income tax purposes, it'll be tax-free. And for some states, you'd have to review whether or not that state complies with the opportunity zone rules. But it's a great tax benefit. You can have a dramatic increase in your after-tax cash flow.
I have so many questions. Thank you for that. Who can claim these incentives? Is it any private client? Is it related to certain ownership structures? Talk to me about what sort of clients would be eligible to invest in opportunity zones.
Yeah, so the clients that we mostly work with on this front are individuals, usually high net worth individuals that have experienced gains from stock portfolios or gains from the sale of their operating businesses. That's our typical client, and that's the typical person investing in these deals. I don't really handle a lot of those types of clients. My clients specifically are the actual funds that are sponsoring the Opportunity Zone project. So if that's kind of a long-winded way of saying, I don't work with a lot of the individuals, but mostly this program is for individuals deferring gains into other funds.
Now, you mentioned that you could take a gain from a stock and invest it into real estate. So how does that work? What are the requirements for the projects that you invest in, and what are the limitations or requirements for the gains that you are applying?
Yeah, so the general rule, it's funny. People would always say, "Oh, it's just like kind exchange," and the reason people would say that is because you're deferring a gain. It's very different than like kind exchange. But one of the requirements is that the general requirement is that when you incur a gain, or when you, realize a gain. When you realize a gain, you have 180 days, generally speaking, from the date of that realization to invest the gain dollars into an opportunity zone. So that's really the first requirement, that you have a gain. It could be a capital gain, or it could be other investment gains from business 1231 gains. But typically you have that gain. Let's say, I'm just going to make up some days here. December 31st. I don't know, 180 days from December 31st. I'm sure is somewhere around June 30th. Not sure the exact day, but as long as you make an investment into what we call a qualified opportunity zone fund, by that day, you'll have an eligible deferral for purposes of the opportunity zone rules. The one thing that I think people don't understand is that deferral of that original gain ultimately is deferred to the year 2026. In 2026, you have to pick up the gain from that original sale. What is tax-free is when you hold the new investment for 10 years. So it gets a little confusing as with the low tax laws. We try not to get into the weeds too much, because every case is so different.
But those two dates were important that you just mentioned. So 2026 is based on when the program first rolled out, I'm guessing, and that's a firm date that those gains have to be realized. Why is that a relevant date?
Yeah, that's a firm date based on the law that was passed in late 2017. They targeted 2026 as the year for recognition of the deferred gains, and basically Congress was trying to balance the revenues and the expenditures of the tax bill that they were passing. And so 2026 was the day that all of these deferred gains that were invested into opportunity zones would be taxed. Now, there are what we call inclusion events, and inclusion events are events that can happen during the life of your investment in an opportunity zone, that would require you to pick up the gain prior to 2026. And we've seen quite a bit of that over the last couple of years.
Now, when does the 10-year hold period come into this? We've got let's say you buy something 2024, beginning of next year. You've got the event in 2026, right, to realize the gain, but then you have a 10-year hold period that is a completely different part of this program. How does that work?
Yeah, so the 10-year hold is measured from your date of investment. So let's say you sell Apple stock, and you have $1 million gain on Apple stock on January 1st of 2024. That Apple stock within 180, that gain from the sale of Apple stock needs to be invested in an opportunity zone fund. And let's just say that investment is May 1st of 2024. So two things you need to keep track of. One, the fact that you had $1 million gain in 2024, and that gain will be recognized, and you need to pay tax on it in 2026. And then also on May 1, 2024, 10 years from that date, you need to hold your investment so that the eventual sale of the opportunity zone investment will be tax-free. So kind of two different dates to keep in mind.
But with a 10-year hold, you could have a completely tax-free sale.
Yeah.
And that's really why people do this, I'm guessing.
Yeah, the 10-year hold is really, there's no other way around getting selling the investment tax-free. It's 10 years or nothing.
What my takeaway is from this is call Sax, call your tax advisor, and make sure you're being very careful if you're trying to take advantage of the opportunity zone tax benefits.
Sounds good to me.
Yeah, you wouldn't mind, right? You wouldn't mind that call.
We have a whole team. We have a whole team here that can help you through your project. So it is complicated. We've been doing it since the inception. I believe One of our clients was one of the first funds, I think, in the country to really start building a project out of the ground. And so we've got a lot of experience with it here, and we're here to help.
That's great. Let's move on to, not going to say less complicated, but a different topic, which is federal tax advice for real estate investors. Now, of course, that is a very broad topic, so we're going to drill it down a little bit and try to share some insights today. Why don't we start with ownership structures and how different ownership structures can impact your federal tax liability? Any thoughts or advice on that?
Yeah, I think, again, super complicated, right? All tax laws or most tax law can be pretty complicated. Federal tax structures, again, you got to make sure that when you're thinking about how an investment is going to affect you, am I holding a real estate investment through a corporation? Am I holding a real estate investment through an S corporation, or is it a partnership, or am I holding it directly in my name? Depending on how you hold the real estate and what your involvement and ownership percentages in that real estate can have a dramatic effect on what your net tax bill is. I think one of the things we try and explain to people a lot, we get a lot of questions on, hey, can I be a real estate professional? Being a real estate professional, there's a lot of facts and circumstances that go into it. You have to prove your hours, you work during a year, you have to document different things, and depending on what percentage of a partnership you own, or a corporation or an activity you own, that activity may not help you get over the hump on being a real estate professional. So, the base advice we tell people, the typical advice we tell people is, in real estate, key things when you're just basic, I guess, rules of thumb in real estate. Number one, generally speaking, you've got to work 15 hours a week in real estate to be a real estate professional. General rule of thumb two is that 15 hours a week or your work in that field needs to be greater than work in any of your other fields that are not real estate related. Rule of thumb number three, generally we don't advise that real estate is owned in a corporation. When you own real estate through a corporation, there's a lack of flexibility on the transference of that real estate, and it kind of takes away a lot of planning opportunities. So we always advise that you either own real estate directly through a limited liability company as a sole owner, or through a partnership. Those are the basic rules of thumb. Tax planning can be so, we take a holistic approach to tax planning. We start thinking about estate and trust taxation and what that means. And so for many, many, many reasons, income tax, estate and trust taxation, succession planning, transferability of the asset, we really like to get people into partnerships, whether they're limited liability companies or limited partnerships, because the form of ownership really has a dramatic effect on many other things down the line.
Great advice. What about the taxing of distributions in these different entities? How does that vary, and what advice do you have there?
Yeah, so that's a big planning point, and that's really one of the main reasons why we focus on advising that real estate is held in partnerships or entities treated as partnerships for tax purposes. In real estate, it's a heavily tax subsidized business. In the real estate world, there are special rules for computing basis, and many times distributions in an entity owning real estate, in a partnership owning real estate, are tax free because of the way the rules work surrounding mortgage debt. In S corporation scenarios and in C corporation scenarios, those same debt rules don't apply. And for either C corps or S corps, and furthermore, in C corps you have double taxation. So if a C corp owns real estate and it incurs gain, there's tax paid at that level, and then if you want to distribute the cash from the gain, you incur tax there. So very important when you're setting the stage up front to buy an investment that you think about these things. We come across many case studies legacy assets and family portfolios where, the assets are held by corporations. Matter of fact, a lot of deals we see in New York City that are legacy portfolios are real estate held in corporations. Going back to the 70s, 60s, we can work around it, but it makes it complicated.
Very, very interesting. What is a common misconception about federal tax planning that you hear frequently? I'm sure there's a list, but pick one that comes to mind.
Just circling back to something I mentioned earlier, people just, a lot of people come to me and they say, hey, I work 9 to 5. I'm an engineer. I work 9 to 5. I'm a doctor. I work 9 to 5. I'm this, but I own all this real estate. So I'm a real estate professional, right? That's probably the most common misconception I think people have is what it takes to be considered a real estate professional. They think it's a lot easier than it really is. There's some other things that are a little more technical I think people get wrong when we start talking about debt finance distributions and the interest expense related to those debt finance distributions. I think a lot of people just don't know what they don't know. There's a long list. We could spend 2 hours going through a list of common misconceptions.
I'm sure.
But am
Those
I
are some big ones.
Yeah, am I a real estate professional is the biggest one. I mean, we just hear some, my cousin's uncle's brother's mother told
Right.
me I'm a real estate professional because of this or that. So, you get that a lot. And then just with general tax law, in 2017, the tax law changed so dramatically. And I think a lot of CPAs in our business just didn't keep up with it. And so, you talk to, when I meet with prospective clients, their CPAs really are kind of stuck in a different era of tax law. There's been a lot of articles in the papers, Wall Street Journal, a lot of people are leaving our profession, the supply of CPAs. And I think that's why I hear so many misconceptions out there. There's not a lot of quality CPAs out there giving really good advice on these topics. It's really interesting.
You have to stay on top of all these policy changes along with just knowing what you've done day to day in its granular form. But staying ahead of the changes sounds like it's crucial as well. Let's move on to state considerations. So we have clients that own properties all over the country. What are some thoughts for non-resident returns? Anything that they should keep in mind if they own in various states in which they are not residents?
Yeah, I think to pull something from your last question on misconceptions. We talk to a lot of people who live in Florida or live in Texas or live in states where there's no income tax, and they assume, well, because I live in this state, that property I have in New Jersey, I can sell it and not pay tax. And that's a big misconception when you're dealing with non-resident issues in these states. It's important to know that real estate as an asset class is taxed where the real estate is located. So if you're a non-resident living in Florida or any state that's a non-tax state, and you have real estate located in a state that is a tax state, you're always going to come across these non-resident withholding issues. We just had a big case in the southeast part of the United States where we had a huge withholding requirement. And I think a lot of the investors were a little surprised that there was a withholding requirement just because they're not familiar, with it. I think the key when you're involved in real estate and you're selling assets or you're recognizing income from operations, you have to be aware of what the state and local tax consequences are, whether it's non-resident withholding, whether it's the new regime, the new state regimes, what we call pass-through entity taxes or PTETs, or if there's opportunities to reduce your tax bill by filing a composite tax return. That in and of itself, I think people are always shocked that the state and local income tax side could actually be more complicated and take more time than the federal income tax side.
So what about the inverse of what you just said? What if someone lives in a high tax state, but they bought a property in, let's say, Florida, somewhere that's income tax free? Is that a benefit because it's taxed where the property is located, or does it
Yeah,
not work that way?
no, it's misconception number four, I guess. If we're keeping tally here, a lot of people ask that question. Hey, I live in New Jersey. I have this triple net lease asset in Florida, in Tampa Bay. I'm not paying tax on that, right? And so the issue is, yeah, you are paying tax on it. You may not be paying tax on it in Florida, but because you're a New Jersey resident, New Jersey is going to tax you on your everywhere income. Now there may be some offsets or some other items that reduce that income from that asset in Florida. But if you're in New Jersey, you're going to pay tax on your everywhere income, generally speaking.
Now, how does your ownership structure affect that, or does it not?
Yeah, it's a great question. A lot of people, through their securities portfolios own REITs.
Mm.
In a REIT scenario, you can live in any state in the country, and if you're not receiving dividends from the REIT, no matter where the REIT's located, you're not paying tax on the value appreciation or the accretion of reserves in the REIT. Now, REITs have their own special rules with required distributions and things of that nature, but that's an example of where you have a corporation, and if you're not pulling dividends out of the corporation, then you're not paying tax in the jurisdiction of where the asset is. So, for example, you have a REIT that owns property in Texas, and you're a New Jersey resident, or actually, let's pick a state that has a high income tax, California. If you have a REIT that owns property in California, and you're a New Jersey resident, and you're not receiving dividends from the REIT in California, then there's no income to pay, and it's not giving you, as a New Jersey resident, it's not putting you into the California tax net. If, on the other hand, it was a partnership, you'd be in the California tax net, and there would be issues there. So ownership type does matter.
Thought it might, but again, many layers and complexities based on state and structure. Last thing we'll cover today, what are some thoughts for cash flow planning? I know there's a lot to this as you're forward looking. What advice do you have for investors when cash flow planning?
Karly, I don't know. I keep looking at the news, and the 5-year and the 10-year just keep going the right way. So I guess my advice would be just stay patient right now. Wait for the yields to continue to decrease. But my advice for cash flow planning, my tax advice on cash flow planning, and general business advice, I think, I'm surprised always at how people. How a lot of people fail to do cash flow forecasting. I think it gets a little hard. When you have a large portfolio, if you don't have a sophisticated financial reporting team, I think it gets a little hard to really plan for bumps in the road. If you got 10, 15, 20, 30 projects going on, and 4 of them have bridge loans, and 4 of them have negative basis, and you're selling the assets, and you forgot that there's going to be more tax than there is cash. All these different things. Should you refinance? Should you not refinance? I think owners, portfolio managers need to take a really proactive approach to portfolio management, especially now with what's gone on in the with interest rates. I always advise people, set up a dashboard for your debt, for your portfolio wide. Create a dashboard, understand what debt is in your portfolio, review it monthly, put a plan together, and manage the bumps in the road. Bridge loans coming due, phantom income being created because you refinanced a property 10 times and now you're selling it. You're not focused on the fact that there's going to be taxable income there. Really think about those things and have a really good understanding of your portfolio.
And I think that's the takeaway from that is there are significant tax implications from your financing structure. It's not just selling and figuring out the gain. These different loans really impact your tax shelter, your overall returns, et cetera. So I think when we're talking about cash flow planning, that's a huge piece, especially given today's debt market and sort of the layers of financing that people are putting on to try to get deals done. So definitely something to take a closer look at.
Yeah, I must say, and I love all of my clients, but the most interesting conversations I have with my clients that were on the credit side of the business, that are now principals, in real estate investment firms. The clients that I have that were on the credit side of the business really do this very well. They understand this. They're passionate about it. But there's all different types of people in this business, as you know, Karly. It's really what they're focused on and what their experience is in the business. When I talk to the individuals, to the executives that were focused on the credit side, whether they were working in a creditor or a large institutional like a bank or a Wall Street bank, or whether they work for a private debt fund, they really understand debt management on a portfolio wide level, and they're really focused on it. And I think when I look at my clients that are doing the best through the last couple of years, I think they were really focused on locking in debt, locking in really great terms on the cheap debt that we had in 2021 and 22. So you got to be proactive about it. You got to really focus on debt. I think that's the biggest part of cash flow planning for real estate companies, and then obviously capital expenditures. You got to make sure that your capital expenditure budgets are good, and that you're not really letting your team get away from that budget without your approval. So if you understand the debt portfolio wide and you understand your capital CapEx budget, I think you'll be in a good place. And then, if you have a great team like Sax behind you helping you understand your taxes, I think that's the third biggest item.
Shameless plug. It's okay. It's allowed. It's allowed.
Shameless plug. I think those three things, you have a really good understanding of those three things, you'll be very, very successful.
I agree. Very important to have the right team behind you and to dive into these complexities, even if you don't want to, right? To stay on top of these things that are a little bit harder to get through. You gave us some, go ahead.
I was going to say, you got to eat your veggies, Karly.
Yeah. Got to do the work and talk about tax planning. It's just not going away. So got to stay on top of it. You gave us some great nuggets today, Eddie, and really some topics that I think, although we can't answer all questions through a high-level podcast, I think it's important that we bring up these issues, we bring up these conversations, and we start the conversation. And I hope this today's episode really gave our listeners a framework to look at their assets, look at their holdings, and look at their tax planning again, and make sure that they're clear in all these different topics and they have a strong strategy for 2024. So thank you for all of that information, and thank you for sharing your thoughts and advice with us today. We're happy you could join the show.
Karly, I really appreciate you having me on, and thank you.
To everyone listening, that was Secret Sauce. Thank you for tuning in, and we will see you again very soon. Have a great day, everyone.